Welcome back. This is Jacob Milliken over at 9M Investments. Today I'm going to be talking about tax planning and specifically, does a Roth conversion make sense in our tax planning? And so I always like to walk through an example of somebody that I have talked to. Names have been changed, but these are real live examples of somebody and how it would affect their situation. I think it's always helpful to see that. So we have Ramon and Norma. Ramon is 61, Norma is 55. They want to retire at 67 and 62. Little snapshot into their world. Roughly net worth of 2.6 million. Savings rate of 13%. So they're both saving into their retirement plan. Effective federal tax rate currently and total effective tax rate. Breakdown of their assets quickly: 71,000 in the bank, 2.3 million in IRAs, 401ks, real estate. That's their home. They have a mortgage on that home, of a little bit of credit card debt. From a tax allocation standpoint, this is why we're looking at a Roth conversion possibly in their scenario. Is all their assets are tax deferred. So that, what does that mean? As they pull out, they're going to pay some taxes on those. And then we want to check to see if the Roth conversion helps them in their situation. Kind of their current allocation, like a lot of people that I've talked to over the last year, a heavy amount in cash. Otherwise, fairly good diversity there, but a big number in cash. And again, not surprising based on the markets we've been dealing with. All right, jumping into their tax scenario, does a Roth conversion actually make sense? So let's dig into it. Looking at their current income, puts them in the 22% tax or the 25% tax bracket for the married couple, about halfway through. So if you look a lot of times the um, with the conversion of, does it make sense? Do we want to fill up the rest of that tax bracket? I mean, we could look at filling it up even higher, but there's always a tax consequence for that. So just kind of for this example, we're going to fill it up to their current tax bracket. Again, it's going to take a conversion from kind of where they are now all the way up to the $200,000 mark, or 190,000 in this case. Um, Also, we're going to just do it over 3 years. Now, in your scenario, we can go kind of play with it several different ways to see what makes the most sense, what is going to add the most to your plan. And this is also very quickly where you can find out, does it make sense at all? Because every scenario is a little bit different. I had two current clients where one of them made complete sense, and one of them it didn't make sense at all. It didn't matter how we ran the numbers multiple different ways; it just never really made sense. So in this scenario, it would add a $361,000 to their overall plan. So let's take a look at what that actually means. And so from their overall standpoint, it takes them from 11 million or 1.1 to almost 1.5. So, from that standpoint, didn't like 361,000. More importantly, though, it really changes their asset look. And so now they have almost 12% in a tax-free strategy. Another thing to really look at is, did this make a difference tax-wise? So their lifetime tax, based on their scenario, is roughly going to be about $2 million. Going through the conversion, that actually lowers that roughly $125,000. Now, you have to pay more taxes up front to do that. So again, that's the question you have to: does it make sense? Does that move the needle enough that over my lifetime that I could pay less? Again, that's where it goes. I can give you the data, but for you, you have to make the decision of, is that enough to do that? Another big one with required minimum distributions, because of that Roth conversion, you don't have to take required minimum distributions from it. So it does change that number over $500,000 different, that you would be forced to take out with no conversion versus with conversion. And then lastly, I always like to look at account balance. So one of the things with the Roth is, you have to remember it is now tax free. And if you have heirs or gifting strategies, that means those assets go to your heirs gift tax free. And so that can be very powerful. Even if these assets are going into a trust, having tax free assets go into a trust can be very important, because the tax rates within those trusts are very much compressed compared to individual tax rates. So again, a good strategy, no matter where that would be heading after you pass. So again, all those things you have to kind of take into account of, does it make sense for you? Going in through the kind of the details of what is the withdrawals, what are we adding, uh, conversion amount here gives you an idea of what would be going in. From a tax standpoint, where does that change my taxes? And so, if this is kind of a more normal amount, you can see it does add quite a bit in those 3 years that you're doing those conversions. So again, we have to walk through, does that make sense to you? Why are we doing those things? Another thing to kind of keep a track of is the Medicare premium. So, you really want to make sure that you stay under this Medicare premium threshold, or the amount of what you have to pay in Medicare also goes up. So something to keep an idea and planning, and working through the numbers for you, what makes the most sense. Maybe it's a lower number that makes the most sense for you, and we can walk through it and make sure that it makes sense for your plan as well. But again, overall, it adds more money. It lowers the taxes in their scenario by 125,000. Those are RMDs owed by over 500,000. So for that client, that would, where they have to make a decision, is like, yeah, those are numbers where it completely makes sense to do it. But everybody's going to be a little bit different when it comes to this, as always. So anyway, I hope this was helpful. If you have questions, please reach out and I'll be happy to help you. Hope we will see you next time. Thanks. Bye.